This came as a couple questions came through on some of my Johnny trades because I've been using my Johnny account to put on these dynamic iron condors. I've done them in Qs, I've done them in SPY, and just, questions around, what it means and what dynamic delta means specifically for those positions, as well as when we mention it for diagonal spreads and calendar spreads. We'll touch on that a little bit tomorrow. We'll get into kind of gamma and how that affects delta and why we call it dynamic delta. But really here, we're going to be talking about the dynamic iron condors, which are some of the trades I've been placing in the Johnny Trader account. So first, a short bit on skew. So skew represents a perceived velocity of price action, of the velocity of risk of an underlying identified by the pricing of out-of-the-money options. So out-of-the-money options that are more expensive where they're more expensive where the velocity of risk is perceived. So a quick way to identify skew is just by looking at equidistant options and looking at those deltas, looking at those option values. If you go $10 out of the money on the call side, $10 out of the money on the put side, the option that's trading for more value is the skewed side. And typically, when you're looking at a underlying, you'll typically see put skew in something like an ETF or a stock. The old adage of escalator up, elevator down, that's kind of priced into the options, where put options trade more expensive further out of the money relative to call options, just because the velocity of risk is perceived to be to the downside. Now, it doesn't mean that the stock is going to move that way, or even that it moves that way in terms of velocity in the short term. It doesn't necessarily indicate where the stock is going to go, especially in the short term trading action. It's just a representation of where speculation and hedges are being priced into that underlying.
Yep. And that's why a lot of people that have had success in the markets over the last couple of years are likely, if they're using option strategy, short premium, they're definitely having some sort of put side short premium in like SPY or the Qs, where the market has historically drifted higher. You're getting paid more to take risk on that side because of this velocity. So it can be a nice trade in those environments.
Yeah. And one more thing to add here just on skew, there are some market factors that come into play with skew, right? So when you look at a commodity like a gold or oil, something where there's a perceived limit to the price of that underlying, like, gold is perceived to have some sort of value at all times. Like a stock can go to zero and the company can go out of business, it goes bankrupt, Bed Bath and Beyond, that thing can go to zero. And that's in the realm of possibilities. The market projects that something like a gold or oil can't go to zero. It's always going to have some inherent value. So a lot of times when you're looking at a commodity, you'll see call skew and call volatility, meaning that as the product goes up, volatility increases. It's a flip of what you normally see with equities or ETFs. Or I shouldn't say flip, it's the opposite.
Yeah, so like when gold reaches lows of the year, you'll probably see some call skew get infused in there, just because of the perceived
more call skew. More call skew,
Yeah.
All right, so dynamic iron condors, most ETFs and stocks will have put skew, as the velocity of risk is typically perceived to be to the downside, typically have crashes to the downside, grinds higher. That's typically how markets move, and that's priced into the options. So when you're placing a iron condor or neutral strategy in something like SPY or Qs or even an Apple or Microsoft, something like that, those iron condors, if they're $10 wide on both sides, they're not necessarily flat delta. And of course, there's some subjectivity to what flat is in terms of a position. A $5 or $10 wide iron condor has very little delta to begin with, but it's important to understand that just because the spreads are the same width on each side does not mean that the position is flat delta. And that's because of the skew, the drop off in the delta on the call side for the long option that you're buying relative to the put that you're buying on the downside. The drop off in delta is much steeper on the call side relative to the put side. So this means that if you're going to 30 delta short option for your short put and your short call, and you go $10 wide, that call that you're buying is going to have a much lower delta than the $10 wide put that you're buying on the downside. And so you're naturally going to lean a little bit short. If you're taking these positions and you want to flatten the delta out by going, let's say, 30 delta on the short options and 15 delta for both the long options, you'd be completely flat delta on that position. But what would happen would be that you would have more risk to the downside because you'd have a further out of the money long put relative to the long call because of that drop off in delta. So to really get a flat delta position, you have to kind of look at those long option deltas and not just the width of the spread. And this is more so the case with wider iron condors, 20, 30, 40 points wide relative to something that's like 5 or 10 points wide where your delta change is very negligible.
Yeah, and it is interesting where if you're selling a strangle and you're going equidistant out of the money and your put side has more value than the call side, your put is taking advantage of the skew there. But the second you go defined risk where you are then buying a further out of the money option, you're actually, and we can look at this in a second, but when you are selling a call spread on a put skew environment, you're actually going to get a bigger credit than doing the same thing on the put side. And that's because when you are buying that long option for a cheaper value to define your risk, it allows you to keep more of that credit. So it's just an interesting kind of inverse relationship when you're comparing defined and undefined risk.
Yeah, and for those undefined risk positions, so it's kind of the same idea. The symmetrical distance away from the stock doesn't necessarily mean flat delta. Your delta for closer at the money options are going to be much closer than those further out of the money options. So when you're looking at a strangle that maybe you're going to like the 35 delta on either side, those are going to be roughly the same distance away from the stock price, even if there is put skew. And so when you're looking at these strangles that are closer at the money, you're going to have that flat delta. As you get further out of the money, you're actually going to start getting long delta. And it's the same idea as the iron condor, just flipped, in that the put, as you go further out of the money, is going to be a greater delta than the call as you get further out of the money. And one thing to keep in mind, though, too, with the change in option pricing now versus the last 10 years, is now you have interest rates priced into these options. So it's actually pulling some of the skew out of the market because it makes call options inherently more valuable because there's a cost to, or there's a value to holding cash. So the skew is kind of coming out of the market naturally just via the change in interest rates.
Yeah, and you can see that the further out in time you go, on an options chain, the more expensive those calls will appear to be.
Yeah, for sure. So altogether, generally, this means that anytime you're trading mostly neutral defined risk positions, specifically, you're going to be more short delta with the naked positions is going to be much less delta on those positions. But as a whole, if you're trading mostly neutral delta positions or neutral directional positions, you're going to have a tiny bit of short delta that goes along with it, which is actually a positive for your positions, especially if you're net short premium. Short delta is a natural hedge for short volatility positions. All right, so I just went to the February monthly expiration, pulled up a $10 wide iron condor, I went to about $10 out of the money on either side to around the 30-ish delta on the upside. 414. I went to 369 on the downside put. They're same delta. To get that totally flat delta, you can see the spread skew a little bit here. On the call side, you got a $10 wide call spread. On the put side, you've got a $14 wide put spread. That's the put skew that's built into that's present in SPY here, in that to get that flat delta, and you can see I have 0.1 deltas here, basically zero. you've got to have more risk on the downside, and then of course less risk on the upside.
Yep. And this is just really delta matching the position. And if there was call skew, it would be the opposite. The put side would have a more narrow spread relative to the call side for the exact same reasons, just inversed.
Yep. And then this next one is going to those same short options, going $10 or $14 wide on either side. I basically just flattened out the risk on the call side, so it's equal to the put side. You can see that even though you've got the same amount of risk on both sides, you're at the same short deltas on the short options. You're naturally going to lean a little bit short delta here, just because of the drop off in the options further out of the money on the call side, because that delta comes off the table quicker.
Yeah. So in these, like we talked about before, the symmetrical width spreads, you're actually keeping more premium on the call side than you are on the put side, even though the naked put is worth more than the naked call. This is the difference here. The further out on the strike plane you go, the less expensive these options become more quickly on the call side relative to the put side. So you're basically keeping about $1.80 on the put side, and you're keeping almost $2 on the call side, because you're not paying as much. You're paying about half of the value that you need to define your risk relative to the put side.
Yep.
And that's pretty much it.
Good stuff.